Hello and welcome. Today, we're diving into one of the most significant updates to UK and Irish financial reporting in recent years, the amendments introduced by the Financial Reporting Exposure Draft 82, or FRED 82. These changes, now finalized as the Periodic Review 2024 amendments, will fundamentally alter how many entities account for key areas of their business, particularly revenue and leases. In this video, we'll break down exactly what's changing, who it affects, and when you need to be ready. Let's get started. We'll structure our discussion into 5 key sections. First, we'll start with a high-level overview of why these changes are being made and what the Financial Reporting Council aims to achieve. Then, we'll move into the 2 most significant policy shifts, the new model for revenue recognition and the move to on-balance sheet lease accounting. After that, we'll cover the various other incremental improvements and clarifications that have been introduced across the standards. Finally, and most importantly, we'll walk through the effective dates and transitional provisions, so you know exactly when these changes take effect and how to implement them. So what is the main driver behind FRED 82? The overarching objective is to ensure that financial reporting in the UK and Ireland remains high quality, understandable, and proportionate to the size of the entity. A key part of this is aligning our standards, primarily FRS 102 and FRS 105, more closely with International Financial Reporting Standards, or IFRS. This alignment promotes consistency and comparability, which is especially helpful for companies operating internationally or as part of larger groups. The amendments focus on 3 core areas: a complete overhaul of revenue accounting, a fundamental shift in lease accounting for most entities, and a wide range of other incremental improvements designed to clarify and modernize existing rules. Let's start with the most significant change: revenue. The old rules are being replaced entirely with a new 5-step model derived from IFRS 15. This creates a single, comprehensive framework for all revenue, from contracts with customers. This model requires an entity to follow 5 sequential steps. First, identify the contract. Second, identify the distinct performance obligations or promises within that contract. Third, determine the transaction price. Fourth, allocate that price to the different performance obligations. And finally, fifth, recognize revenue as each performance obligation is satisfied. This new model affects both FRS 102 and FRS 105. For entities applying FRS 102, Section 23 is completely rewritten. The new section is designed to be functionally equivalent to IFRS 15, which is a huge benefit for groups that need to align their accounting policies. For micro-entities under FRS 105, Section 18 is also revised, but with crucial simplifications to keep it proportionate. For instance, when dealing with variable consideration, micro-entities only need to measure the amount that is highly probable to become due, a more straightforward threshold. Furthermore, they generally won't need to account for the time value of money if payment is deferred for 6 months or less, which greatly reduces complexity. The second major policy shift is in lease accounting, where FRS 102 is adopting the on-balance sheet model from IFRS 16. This is a game-changer for lessees. The old distinction between, quote, finance leases and operating leases is being eliminated. Under the new model, almost every lease will be brought onto the balance sheet. This means a lessee will recognize a, quote, right-of-use asset, representing their right to use the leased item, and a corresponding lease liability, representing their obligation to make lease payments. This provides a much more transparent view of a company's assets and liabilities. It is crucial to note that this complex new model will not apply to micro-entities under FRS 105. This decision was made in response to stakeholder feedback about the significant cost and complexity it would impose on the smallest businesses. They will continue to use the existing lease accounting model. To ease the burden for FRS 102 preparers, several optional simplifications are available. These include recognition exemptions for short-term leases, those under 12 months, and leases of low-value assets. There are also practical expedients available, such as allowing a lessee to use their own obtainable borrowing rate if the rate implicit in the lease isn't readily determinable. Beyond revenue and leases, the review introduced a host of other important, incremental improvements. First, the conceptual framework in Section 2 has been revised to align with the IASB's 2018 framework, updating the fundamental principles that underpin the standards. A new Section 2A on fair value measurement has been introduced, replacing previous guidance. This aligns the definition and measurement principles with IFRS 13, ensuring greater consistency. For UK small entities, Section 1A has been amended to provide much-needed clarity on the disclosures required to present a, quote, true and fair view, reducing the level of preparer judgment needed. There are also several other clarifications. A formal definition of accounting estimates has been introduced in Section 10. New disclosure requirements for supplier finance arrangements have been added to Section 7 to improve transparency. In Section 24, it's been clarified that government assistance provided via the corporation tax system isn't automatically excluded from the scope of government grants. Guidance has also been added on how to account for uncertain tax treatments, and the rules for identifying the acquirer in business combinations have been clarified. These changes collectively aim to make the standards easier to apply and more robust. Finally, let's talk about the timeline. The mandatory effective date for the bulk of these amendments is for accounting periods beginning on or after the 1st of January 2026. Early application is permitted if you wish to adopt the new standards sooner. However, there's a key condition. You must apply all of the amendments at the same time. You cannot pick and choose which new rules to adopt early. The one exception to this timeline is the new disclosure requirement for supplier finance arrangements, which comes into effect 1 year earlier for periods beginning on or after the 1st of January 2025. To manage the transition, the FRC has provided helpful provisions. For the major changes to leases and revenue in FRS 102, entities will use a modified retrospective approach. This is great news for preparers, because it means you do not need to restate your comparative information from the prior year. Instead, you calculate the cumulative effect of the accounting change and recognize it as an adjustment to the opening balance of retained earnings on the date you first apply the new standards. For micro-entities applying FRS 105, the transition for revenue is even simpler. They will apply the new rules prospectively, meaning it only affects contracts that begin after the date of initial application. So, to summarize, the Periodic Review 2024 amendments represent a significant modernization of UK and Irish GAAP. The alignment with IFRS for revenue and leases will bring greater consistency, while the numerous clarifications will improve the overall quality and usability of the standards. The key now is to prepare. Even though the mandatory effective date is January 1, 2026, the scale of these changes, particularly for leases, means that entities should begin assessing the impact and planning their transition as soon as possible. Thank you for watching. I hope this breakdown has been helpful in understanding the important changes ahead.